Welcome back. It's another episode of the Freight 360 podcast. If you listened to us last week, we're going to continue that conversation this week. We are rejoined by Dean Croke from DAT. We'll skip our news and sports intro because we want to spend as much time with Dean as possible. So, Dean, welcome back. You just dealt with the nor'easter in Nantucket. How'd that work out for you?
Yeah, pretty good. I feel like we've been at this for 5 years, right?
Yeah.
Like, haven't we been talking together during the pandemic?
Yeah. I think that's when we've been. What do you think? I think 2020, late 2020, right? We first started doing all of our stuff with DAT in general, right? Between Ken and Dean. So
I feel like that's how long we've been talking together. I was just sort of thinking back to when we first started talking together. It's been that long.
Yeah, one of our first conversations on a podcast, we learned all about like your background in Australia and doing those like the train, basically like the multi-trailer train runs, from one side of Australia to the other. So we've come a long way.
Yeah.
But good to have you back, Dean.
Yeah.
Ben, I'll let you kind of kick things off. We're gonna pick up where we left off, talking about what happened in the freight market the last couple of weeks with enforcement, and it's getting national attention. So this is kind of obviously we're in the spotlight. But Ben, where do you want to go with this?
Yeah, I mean, to be honest, the driver enforcement and just like what's been. And it's kind of crazy that I'm saying this, that like most of this is what we're seeing on like Twitter and X. But I mean, I was telling Nate this and my wife, it's just like, I don't have like an aversion to social media. And I realized the other day, I think I know what it is because I was trying to read and Steven sends me a bunch of stuff, will text me a link and then I'll go read it. And I'm like, oh, most of what people are talking about seems to be here. And it literally made me motion sick. Like scrolling and doing this, I got up and I'm like, I really feel nauseous. Like when you read in the car, right? I'm like, this is why I just can't stare at this all day. But I mean, there's a ton of information out there. There's a lot going on, again, with enforcement, Secretary Duffy, and they're doing more with the DOT and FMCSA. I'm curious, because you have a ton of experience on both sides of things, right? Not just the freight side, but also literally driving a truck, speaking with drivers. You're out there, you're talking with folks literally being affected by this. Like, I mean, just tell us kind of what you think and where this kind of came from, because I'm just genuinely curious what your point of view is on the enforcement alone and how and where it's being applied. And then we can talk a little bit more on like what the overall effects might be on rates and like the whole market, I guess.
Well, also as an immigrant CDL holder, right? Yes. So there's another perspective here, because there's more than a hint of racism about what's going on behind all of this, because that's how this started back in March. Because remember, this started with English language proficiency. So this didn't start as a federal program to improve the 1 in 5 Americans that are considered illiterate, right? This didn't start with, let's improve the 65 million Americans who are considered illiterate. Let's help lift the standard of a lot of people who are, problematic with the English language. It started with, let's slash federal worker numbers, right? That's how it didn't start. It started with some poor trucker who was trying to make a living. And it started on social media, of all places, right? So it started in the worst possible place. And I said from the get-go, well, if I'm a trucker and I'm in Arkansas and I have a problem with English language, the last place I'm going to be is on the road in Arkansas. I'm going to go to ground. So it's not so therefore it's not going to have an impact on rates, because I'm going to go to ground. The effect, so the idea that we're suddenly going to have all of this enforcement and it's going to have an impact on capacity, it already had an impact on capacity in early March, because everyone went to ground, right? So the idea that we were going to see some sort of impact on capacity in April, May, and June, it was never going to happen. It already happened in March. And that's why you never really saw the national rate needle move, and why you're not seeing anything happen now with both English language proficiency or non-domicile CDL holders. The numbers are just too small. And so I'll move to my next point, which is for 2.5 decades, we've been recruiting drivers from both here and abroad in great numbers. So is it any surprise most over the road truckers are of a second or third generation immigrant truckers, right?
Yep.
It just turns out they're not the right type. Lo and behold, after recruiting them for best part of 30 years. So the problem now is that it's like the squeaky wheel gets the most attention on social media. That's where you kind of started. And I fear that the people with the loudest voices are starting to win, right? And they're starting to have a big effect. And part of me is ashamed to say this, but it's actually starting to have a good effect. Because, and I'll say this as a trucker with a CDL, because the fact that some people have got trucker licenses and they can skate by and not have to go through the same rigor to get a CDL and have a DAT physical that I have to, that really gets under my skin. Because, I have to work hard to keep my blood pressure under, 90, under, 90 over 140, right? That's just to hold a 1-year card.
Yep.
These guys that can get by with a CDL and not have to go through the same standards I do, that's not right. So I think there's some good things that are coming out of this. It's a bit like the Equalizer. You know the movie with Denzel Washington? Yep. Sometimes we have to do the wrong things to get to the right place. Remember that discussion on the step, right? We have to do the wrong things to get to the right place. Well, I think this is what we're doing here. We're doing the wrong things to get to the right place. And I think what we're going to end up with is a much better standard of trucker. It's going to be very hard for companies to get A, into this industry, and B, to stay in this industry. And it's going to be very hard, with biometrics, with all of the things that companies have to do to get a DOT and an MC number. Same on the broker side. And then with drivers to get into the industry. So it'll be harder to get into the industry with if you come from another country, because now you're going to have a H2A, H2B visa or an E2 visa. But I also think those numbers are very small. I don't think the non-domicile CDL numbers are anywhere near the level that they're talking about.
That was the one specific thing I was really curious on your opinion on, because a lot of people had reached out to us. We did some episodes with a bunch of folks that Steven's been working with that have been looking and uncovering. Oh, honestly, like it started mostly with the fraud, chameleon carriers, reusing MCs. Then it was a whole rabbit hole on ELD manipulation and this giant backdoor where basically all of this data is basically just getting sent to whomever to steal freight.
Yep.
And the more we dug in, honestly, I was kind of terrified, because I'm like, this is so much worse than I ever would have guessed or expected. So when these crackdowns started coming in, folks were reaching out and asking me well, what do you think the numbers are? And I was talking with Jason Miller about this. I think it's last week, where he was like, we've never seen capacity, right? A shortage of capacity really affect the rates. It's almost always from the demand or the freight side, right? And I was like, okay, well, we saw it temporarily with the ELDs in 2017, where capacity temporarily shrank for about 4 or 5 months, rates went up, and then they kind of came back down.
Yep.
And the question I asked him, which is kind of the same question I wanted your point on, is okay, we look at all of the stats and everything Jason Miller puts out and everything that all of us read, right? And I think all that is great information. But the point I was making is they all have an underlying assumption that everybody's playing by the rules. Right. And I was we're literally seeing, again, some of it's anecdotal, some of it is really objective evidence of drivers for sure violating ELDs, driving way longer than the hour service regulations. Oh. We're seeing the FMCSA estimating 200,000 drivers they think are non-domiciled that maybe will be removed over the next year or so. I'm theoretically, just as a thought experiment, I'm if that number is 400,000 drivers that are either driving longer than the legitimate regulated companies playing by the rules are, there is some argument to be made that it could have an impact. It's just how quickly and how many of
I think
violations are really out there.
Two things there. I think the non-domicile CDL number, I think, is I don't think it's anywhere near as much as what they're making out. right? I don't think that's over 2 years, right? That number has got to be, and I don't think it's as much as what they're making out, right? I think that's a separate number to the illegal carriers that are swapping MC numbers, DAT numbers, drawing their numbers on the side with crayons, Crayola, right, or fake numbers. There are a lot of trucks out there that I think are not real, but whipping up and down the roads. I think what you're getting at, and Stephen's getting at, is there are trucks out there that look like truck companies that are not real.
Correct.
That is something that I find very hard to quantify because I've seen them.
Yeah. Like we've all seen it anecdotally. And I'm like,
So,
the thing I wanted to say that it kept coming back in my head, and Nate and I, we've talked about this a while, is like, I have brokers for the past 2 years that have argued with me, right, that like the transit times for their loads are wrong because their drivers run 800 to 900 miles a day. And I'm like, that, like, just physics. I'm like, that is an impossibility unless they are driving longer than they should or doing something that shouldn't be happening, right?
You're Australian.
Correct.
Come on. No, so seriously.
Well, I thought about the stories you told us years ago. We were talking about this off air of like literally on the convoys in Australia where you were putting, I think you told us you put hot sauce in your eyes to stay awake because you guys were driving like 15, 20 hours a day.
No, you pull your nose hairs out.
Are you sitting on hundreds of thousands in old, uncollected invoices, 2, 3, even 4 years old? Don't write them off. You could be losing big money right now. Meet Christina Bellival, Texas's #1 freight debt collection attorney. She's recovered over $20 million across 1,700 cases using legal muscle that forces deadbeats to pay you, usually within 30 to 90 days. She's the powerhouse behind some of Texas's biggest carrier and factoring companies. There's no fees until she collects. Your competitors are already calling for their free account review. Don't let another day of your money slip away. If you've got a claim in Texas, visit freightcollectionsolutions.com or call 346-525-2229. Call now before the deadbeats disappear with your cash forever.
Tired of struggling to find accurate rates and the right carriers for your freight? With DAT1, you can access more than 500 million posted loads and trucks every year. That's 3 times more capacity than any other load board. Plus, their integrated freight management system makes it easy to cover loads 24/7. They have the most trusted network of carriers, brokers, and shippers in the country. You'll get real-time rates on every lane so you know exactly how much a shipment will cost before you commit to it. Plus, you get instant access to top bids from qualified carriers around the country. Get 10% off your first year of DAT1 when you visit the link in the show notes.
That's what it was.
That'll do it.
No, but seriously, our logbooks allow us to run 14 hours a day, so 700 miles is table stakes. But seriously, this is where you have 3 drivers in a cab, and you do all sorts of crazy things. But there is something to this, and I have sat in truck stops when I've been out driving my truck, and I have seen the drivers in the cabs doing this and cooking their own meals in the cabs. And when you're in a truck and you're talking to other drivers, they let their guards down and they talk to you about what you're doing. And it helps when you've got an accent like I do, because they talk to you, they realize you're not from here, as in the US. And I've seen some things and I've thought, holy crap, what are you guys doing? And a lot of them are reefer carriers. They're hauling produce. They're doing cross-country work. And this kind of gets to what I'm seeing in the rates, because it's not necessarily dry van work, although I do know what happens. I'm seeing some stuff happening with dry van rates, and this is this theory that Ken and I've got about road check week effect that seemed to be mostly with refrigerated carriers, where we're seeing this road check week effect with rates. But I think there's something to this where we're seeing a lot of carriers selling MC numbers. There seem to be some, and I'm kind of all over the place here. I was in a truck stop going to a convention in Wisconsin. I was on the west side of Chicago in a truck stop on I-94, and I was listening to a couple of Middle Eastern carriers talking about selling MC numbers in their trucks. And I couldn't quite, their broken English wasn't good, and I couldn't quite grasp exactly what they were saying. But they were doing a deal about selling their Freightliners, and they were talking about their MC numbers, and a number of $19,000 was discussed. And I kind of thought, holy
For
crap!
one MC number?
Yeah, and I thought, holy crap! I'm hearing this real, like this is what people have been talking about
person, yeah.
person, and I'm not trying not to be a dork, and I'm standing behind these guys and I'm trying to eavesdrop without really being so obvious about it. And I thought, oh God, I wish my Russian was better, because
I got to insert myself into this deal somehow.
Yeah, I'm thinking, holy shit, if I could really get inside this conversation, I've probably untapped the holy grail of what's going on in this industry. And of course, I'm in the epicenter of all of this stuff that's going on in the Chicago market that we heard about for like 3 or 4 years. And then lo and behold, out comes this article last week on FreightWaves from the immigration attorney that says to all of his drivers, the Serbian drivers, don't get on the road this week because they're going to arrest you. And I thought,
even if you're legitimate, I think the article, I think his statement was, even if you are playing by the rules, right, and have the right documents,
not worth it. Yeah.
Just because they have no idea how long you'll be processed, you could be sitting in there for years, I think was the sentiment.
So 2 weeks ago, I spent the week in Salinas. So I've been out in Salinas talking to all of the Punjab Sikh drivers, meeting with freight brokers, insurance brokers, farmers, growers, coolers, the cooling houses, and getting deep into what's going on in that market. Now, this is just more coincidental that all of this was blowing up, and I'm talking to, of course, the Punjab Sikh drivers are American citizens, and some really cool guys, like great truckers. These guys can outdrive anybody. And of course, they're saying, I'm not going anywhere near the border. I'm not leaving Fresno. I'm not leaving Salinas for any money in the world, because they don't want to get harassed.
Yep.
Because guess what's happening to loads out of McAllen? You can get $1,000 more for a load out of McAllen back to Los Angeles this week than you could this time last year, right? Because they're not going there. They won't go there. So what you're seeing is, so that you're seeing freight rates on backhaul lanes back to the West Coast, where the capacity comes from, going up. So this is
like the lane we saw the most, that I was asking Ken about this, because I'm like, again, it's anecdotal. It was like 6 or 7 loads last week, but we saw massive increases from Georgia and South Carolina to Texas.
Yep,
like long haul heading back over to the West Coast. We're like, and I'm asking my team, the other thing that I always say is, I'm like, that's one transaction, but like, what are you guys hearing? And I'm like, when you've been running this lane for 2 years, they're like, we would have 30, 40 carriers reach out to us for this load on a daily basis. We're hearing 3 or 4 now. So there's less interest and higher rates. And I'm like, again, it's anecdotal, but I'm like, every week I'm looking at the same situation. I'm like, we are seeing huge increases on these types of lanes within us, right?
Well, Ben, it's like, go back to March when the TikTok video popped up about the poor driver that was apparently arrested and fined $5,000 because he couldn't speak English. Whether it was true or not, no person in their right mind would have been on any interstate anywhere in Oklahoma or Arkansas ever again if you couldn't speak English. You would have said, okay, the gig's up. I'm done. So now, and apparently when I was in Salinas, the guys said that ICE grabbed 3 of them last week. This was 2 weeks ago. So, this is a very tight-knit community. They all had very strong social networks, and they would have said, okay, we are not going to McAllen to load produce across I-8. And so what that means is that capacity then diverts to other markets. And of course, they were all saying, well, let's run to the Northeast. So plenty of trucks wanted to run to Boston, but no one wanted to run to McAllen or Laredo or El Paso. And of course, on our load posts on Saturday morning, I'm looking at Nogales. Brokers' load posts were up 95% last week out of Nogales for loads to the East Coast. Nobody wanted to go to Nogales in the Tucson market. So when I look at our load posts across all of our border markets, the brokers were really trying to find capacity because no one was wanting to go there.
Yep.
So that's what I'm finding is that you're seeing capacity tightness in those markets where you could almost throw a net over. No, it's probably the worst thing to say. Where ice is active, right? Where ice
I'm
is
sorry,
active,
but it was a
Great
really fun
word.
pun.
it's an awful thing to say. Again, we're doing the wrong thing to get to the right place here. But what we're finding is that I think wherever you're seeing this enforcement activity, you're finding capacity is adjusting, and that's where I think the backhaul lanes are reacting.
Okay, so I had a question about that, right? And this is one of the things that I was messaging Jason, and I was curious your and Ken's thoughts on. Is it like, I mean, I have a pretty good understanding of DAT's rate data. Like, we've literally interviewed almost everybody in your organization, had conversation on what is going into there, what makes up these numbers, that it is the median, it isn't the average, the top and bottom 25 percentile are being excluded on that range. So you get a tighter, more, say, it should be more likely you will pay within that range, right? Instead of the anomalous ones on the top or bottom. Now, the other thing that I read last week and the week before was everybody saying like the larger trucking companies aren't being affected yet. And okay, so the thing that I was curious, right, is I'm like, that would make sense, right? Because the smaller companies, right, or the people that are driving in ways that they shouldn't, whatever that bucket is, right? Whether it's the CDL, violations of hour service, whatever, like that wouldn't affect the larger companies first. And also you have the inverted yield curve, if you will, meaning like contract rates, right, are still higher than spot rates, which should never happen economically, but has persisted for 3.5 years. Right. And I'm like, okay, normally the market will shift and rates go up because the spot market spikes. Contract drivers will jump to the spot market to make a premium, and then tender rejections go up. But since we have an inverse economic situation, meaning like spot rates are below contract, we first need them to go back in line, which wouldn't happen with the larger carriers first. It would happen with the smaller carriers or individual either owner ops or very small trucking companies.
You've seen the headlines. Freight fraud isn't going anywhere. But if you're a QuickScope customer, you're not seeing it in your business. QuickScope is a cutting-edge load-level visibility tool that stops fraud before it starts, right where it happens. Inside the transaction, no noise, just results. With unlimited usage and by far the most cost-effective product on the market, QuickScope delivers real value without the bloated price tag or platform confusion. And here's the kicker. Version 2 of QuickScope drops this summer, packed with powerful new features and AI integrations that'll make your visibility game even stronger. Sign up today and you'll be locked in at today's pricing when version 2 goes live. Stop chasing fraud. Start stopping it. Visit quickscope.com. That's QUIKSKOPE and learn more. In freight, time is money and efficiency is key. That's where Levity comes in. Imagine automating your email operations to do more with less effort. Levity connects directly to your inboxes, extracting vital information from emails and attachments in real time. It seamlessly integrates with your TMS, empowering you to quote faster, build loads more efficiently, and book more freight in less time. Whether it's incoming emails from shippers or carriers, Levity's got you covered. It understands any language, any format, and even interprets non-standard formatting. Visit levity.ai today to sign up and get started.
And I'm like, okay, well, those drivers are more likely to work in the spot market with smaller brokers.
Right.
Less of them are reporting their data to anybody. I mean, they are in one way. Most of it's getting factored, so it's probably eventually making its way into the bigger models.
Right.
But there would be a time lag to seeing that, and you wouldn't see the impact you would the way you normally do because it's not happening at that scale, right? Because like literally what you said and what you're seeing is what we're seeing, and I'm like, I was not making the argument that it's going to move the whole market up, but I'm making the argument, or I guess I'm very curious your thoughts on like, if theoretically enforcement increased and became more consistent across the country, just theoretically, right? And now you don't have people dodging areas where enforcement is, so you don't see less here and then more here. You would see all of the, call it, I don't want to say, I don't want to even use the word illegal, but like say like the carriers or the drivers.
Capacity. Those that are at risk of getting,
Right. If they exit the market, like
Right.
you would likely, I think, see spot rates finally go back above contract rates. And then you would probably see when you have produce, because this shopping season's been terrible. If it was a normal year, you probably would have started to see what we've normally seen in the market for 40 years that we haven't seen for 4 years, I guess, is another way to ask it. If that even means, I know it seemed like a very long question.
I think it does. But there's something that's been suppressing the spot market.
Yeah.
There's something anomalous, right? And I think what you've been seeing is it's almost like the waterfall effect. It's almost like the waterfall's been broken, stopped, right? And because I think what's happened is shippers have routing guide compliance has been exceptionally high. Tender rejections have been historically low.
Yep.
And what we found with our shippers is they carved out low volume lanes, which historically had high levels of tender rejections, and they went to you guys with a strategic buy. So if they carved out high volume lanes to their incumbents and gave them to their prime contract carriers, and they have 98, 99% acceptance, right? And awarded them to and that was a post-pandemic deal, and that's been pretty well, ongoing. So, and I think, if you have like sort of maybe 1 to 1.2 routing guide depth, you have very little tender failure. Right.
Basically, and for anyone out there that's just from like, as Nate would say, like Barney style, right? 101 level, meaning all of the shipments that the large companies have said they would give to the trucking companies are not only taking them, they're not giving them back, which means you have a lot less problems with large shippers making sure their freight gets picked up, which usually doesn't happen.
Right. So then your waterfall effect, you haven't got loads falling down through your second, third, fourth cheapest carrier and then falling out into the broker market. So what you've got is then you've got all of these low volume lanes that normally would be high failure lanes going to the broker market. Instead, they were carved out of the bid and just directly going to you guys for a strategic buy.
And I want to add something to it. The other thing that I've heard, I mean, fairly large companies that I've talked to, like literally that are our customers, right? And asked them some of these questions. One of these companies is a very large auto parts like supplier, right, in the US. They are doing no RFPs. And like they've never done that ever, but have been for 2 years, meaning like literally they're just pushing everything onto the spot market. And their on-time expectation, meaning like normally a company that large that has like 25 or 30 distribution centers expects like 97% of their loads picked up on time. Their benchmark, they said, was 96 or 97 for their carrier scorecards. This is 3 or 4 years ago. Now their expectation is 80%. And they said, we are literally just giving all of our freight into the spot market because we've saved money. So we're literally just not contracting anything. And I'm like, that to me, I thought is pretty crazy for a company that ships probably 1,000 loads a week, right? Yeah. And then the other thing I saw was very large food company in the US, like probably Fortune 200 company. I ran probably a 4,000 lane bid with them. When we got our feedback, we were at the low end of DAT on every pretty much lane we were putting a number on where we had carriers that would run it. Their feedback to us was, you're 15% higher than what we're paying. And I'm like, the number, right, of them, like just the scale, literally hundreds of lanes and thousands of loads. They're saying we were 15 to 20% too expensive. And I checked, I looked at predictive, I looked at DAT, I looked at historic. I'm like, we are on like the low end of the collar, and they're saying every single one of ours are 20% too expensive. And I'm like, how is that even possible? Like, because that's front haul freight. Like, that's not even back hauls.
Yeah.
Like,
well, so now the other thing, Benjamin, we haven't talked about is finance companies. So not only have we, it says the reason that a lot of companies are out there doing the sort of rates that have been supporting this, what you're seeing is finance companies have been supporting a lot of these companies that are running these rates that are supporting what you're talking about.
When you say finance company, what kind of companies are you referring to?
All the big finance companies that financed a lot of these carriers into the industry in the last 3 or 4 years, they haven't foreclosed on them because the trucks have been worth nothing compared to what they financed them.
Oh, okay. So the people that are holding the note
paper.
on
The note's worth nothing compared to what they financed them for. So they've been
It's the same thing that happened in the real estate market. When all the valuations came down, everyone went, there's going to be a massive foreclosure. And all the banks went, we don't want the property back because we're going to lose our asses, pardon my French on this. So basically what you normally see is when you don't pay for something, the bank takes it back. Right. And that's not happening with loans on trucking equipment. Is that what you're saying?
Not PMI when you buy a Class 8 truck, unfortunately. So
that's the other wrinkle in this debate. Is if they start to call in those notes and say, we're going to cut our losses, that's when you'll start to see some of this capacity disappear also. So it's been part of the reason that we've seen this elongated freight market. We are at a point where there will be a clean out in this market, and I mean, it can't come soon enough because some of the stuff, those rates you're talking about, that's just absolutely crazy where a large auto parts or a food manufacturer can run with rates so low and accept those sorts of service levels. Like that's...
Yeah, I was literally going to email it to you. In fact, I think I might have sent you a few of these things a couple months ago when I was really seeing more of it because I'm like, again, I just keep coming back to I'm like, economically, this makes no sense. I'm like, there is literally no explanation as to how this could occur. And it's like, okay, if it's a load here, it's a lane here, it changes a little bit. Like things happen, they're anomalous that you can't understand. But like when you're seeing this on thousands of loads, right? Or hundreds of lanes with a company that like everybody would know their name, right? If I said it, is like probably a Fortune 100 company. And I'm like, 3 or 4 of them that like I've now seen at this point. And I'm like it can't economically, the math can't not math for years without something occurring that shouldn't be happening.
Right. Now, the problem we've all got here, of course, is with the way geopolitics are working and diesel prices somewhat being artificially kept low because of geopolitics. That is not helping things either, right? What you really need is geopolitics doing what they normally do and forcing diesel prices higher. That would really help clean out some of these marginal companies. Of course, they're not, and diesel prices are helping, adding a real tailwind to some of these companies. It sounds bizarre to say that, but diesel prices have been a real tailwind to a lot of these carriers because they're allowing them to keep their operating costs somewhat lower than what you'd normally expect, given some of the craziness that we've been seeing. So again, we're in really weird times where you would normally see, there's a case, it was only a few years ago where diesel was $5.80 over the summer. There was a case where you could have said, why aren't we seeing diesel prices so much higher than what we are now? We're in the weirdest of times where diesel prices are in the $3.70 range when they could be much higher. So
one of the things I want to put out, like, not to add a whole bunch of other factors to the conversation, but like when you talked about the equipment loans, the PPP loans also came out around that same time, which were forgiven, and then to add into that, the CAS rating came out, and it's the lowest volumes have been since 2020. So, I mean, do you
2008, I thought, right? Wasn't it like...
Was it 2008?
It is. Is it the same period? It's basically bouncing off the lowest number of freight, I think, and Dean could probably talk the specifics, as like right prior to pandemic or right beginning of pandemic and the Great Recession. So in the past 30 years, the least amount of things being made and purchased or moved in the United States is where we're at, like literally right now, going into the holiday season. And like it should have been picking up and it just fell off a cliff.
So I guess my question with that is, do you think with freight volumes being so low, if freight volumes had started to come up the same time enforcement was going in, do you think that would have painted a better picture?
Oh, yeah, absolutely. Yeah, so Stephen, here's the problem, right? Because this is like when the drug enforcement deal came in the start of 2020, we would have had a much more noticeable effect if the pandemic didn't happen. Because the pandemic happened and we really didn't notice the whole deal, right? And here we are, we've got non-domicile CDL, English language proficiency, and now we've got demand sliding south. and we're not going to see the effect that I think we would normally expect to see. And that's what I think is going to happen. We've had a big pull forward of inventory in July. We've already had peak season. We're going to see very flat demand. Manufacturing is the biggest driver of freight demand. It's very flat. I did a presentation yesterday. Backlogs of manufacturing backlogs are decreasing. They're a very strong predictor of dry van rates. Normally, when backlogs of orders go up, dry van rates go up a couple of months later, but backlogs are going down. So dry van rates are going to go down eventually. So things aren't going in the right direction. And that just means that anything we do that's going to reduce capacity, we're just not going to see the impact of it on freight rates, because demand is just going to undermine all of those things that we're doing on the supply side. So
let me ask a question. And I want to make. I'm gonna approach this from a.
No, my computer just like stuttered on internet. So finish your thought. Go ahead, sorry.
All right. So I'm gonna ask a question, and it's gonna be more of like a devil's advocate perspective. So earlier, you guys were talking about tender rejection rates being 1% or lower, and from an outside perspective, couldn't a business consultant say, you're running a very efficient operation, this is a good thing, right? And when trucking rates are as low as they are, couldn't you from an outside perspective say, this is a good thing for the consumer, right? So here we are and I think it's just an interesting point to have, because on the inside we're like, yeah, but no one's making money and this can't sustain forever. But on the outside, shippers are like, we're running efficient, our transportation costs are low, and as long as our freight's not getting stolen, what does it matter? So what do you think I guess if you look forward, what are some potential courses of action that we might see here, whether it's something bad happens and it changes it, or economic activity goes up and that increases the demand? What are some of the realistic courses of action that we can expect to see in the next year or so?
So this is the dangerous game that shippers play, and Derek Leathers tipped his hand to what's coming last week at a conference. So tariffs, he was talking about a 25% increase in the cost of aluminum and steel. And what he was saying was, at the bottom of this cycle where everyone's margins are compressed, when we start to buy more trucks to replace the ones we've got, if they start to cost more money when we buy more trucks during the next freight cycle, everyone's rates are going to go up. So what he was saying to shippers was, when we start to buy more trucks in the next freight cycle, it's going to cost you more money. Right. So it's very interesting discussion. What he was saying is, in the next bid cycle,
to a shipper,
he wasn't saying it to his shippers, but he's starting to telegraph the discussion in the next bid cycle. He's saying tariffs are going up, cost of trucks is going up, get ready. So it's a very interesting discussion.
It's
now,
good
what
to
he's
set
saying,
that expectation, though, because that is the reality. It is going to all come to that at some point.
So shippers have had pricing power for 3 years. New rates coming into routing guides based on recent RFPs are flat to down about 1%. But what's happening is, so to answer your question, Nate, the bottom of the freight cycle, where your margins and carrier margins have been compressed to the lowest they possibly can, carriers are saying our costs are going up in the order of range of 3 to 5% in the last couple of years. Our rates, though, have gone down about 1% over the same time frame. We can't absorb any more rate decreases because our costs are going up. The danger for shippers is we could go out of business. So the carriers in that 200 to 700 truck range are an accident or a lost contract away from going out of business, right? That's the real danger here at the bottom of this cycle, is capacity could exit rapidly.
And you could see it twofold, right? Because you were on we talked about this like 2 years ago, because I've reiterated what you told us 2 years ago, where basically what we saw post-pandemic was a carrier market. It was like a tale of two cities, meaning like you had carriers that saved a bunch of money, and you had also carriers that bought trucks really cheap, pre-peak in the pandemic. And then you had other carriers that bought trucks late in that cycle, spent a lot more money. And you said, this was probably about a year and a half ago. And I remember you're like, what we're likely to see is the coffers are starting to run bare, meaning like the savings are gone. And also all of these trucks are now been driven long enough that they will need full rebuilds. And you're like, you basically have two choices. You buy a new or more expensive truck to keep running, or you rebuild it and the cost for the rebuild went up. And you're like, economically, like this is going, basically the chickens are going to have to come home to roost because like there's no way you can just keep deferring costs. Like as a trucking company, you're making less and it costs you more to operate. There's only a certain amount of time. And like that should have been like a year and a half or 2 years ago, which is why we were talking about in the first half of this conversation of like, the math hasn't mathed for a very long time. And if this happens, meaning you get rid of everybody driving in unregulated ways and the legitimate companies go out of business at the same time, you could lose giant tranches of the carrier market. Like,
and you're hearing it. And you're hearing it now, the Tim Denoyer in the CAS shipment report talking about carriers deferring maintenance costs, deferring maintenance programs. So you're hearing it now at a national level where fleets are starting to do that. Benjamin, at the FTR conference, they were talking about this very thing. Carriers are talking about an economic recovery not happening until 2027. They were talking about operating costs being cut to the bone. Like, so carriers are actually talking about being in a very precarious situation where current operating costs are unsustainable absent rate increases. So, Nate, your question is, if they don't see rate increases in a material way in short order, there'll be a number of carriers forced out of this industry. And what that means, I think, Benjamin, you were getting at, is a flip. So if you don't see a rate increase that starts to lift carrier profitability, you see the market flip quicker, where the gap between spot and contract the gap closes quickly, and you see that rate inflection, and then you see routing guide compliance failures happen faster, and then you see the market take off, and that could happen sooner than later.
And I would have made the argument that if the tariffs had not happened, if any of that just didn't occur, meaning like we just kept going on as a country, like we were coming out of the pandemic and things were growing, people were building and things were picking up, and then all of a sudden we renegotiate all of global trade in a short period of time and everything just shrinks, right? Because I think had that not occurred, what we're seeing, if you layer on enforcement with a normal economic cycle, like this would have flipped at the very least a year ago, if not probably beginning of 2025, if not sooner.
Well, you go back and look at Jason Miller's post about 2 weeks ago where he looked at the aggregation of 5 Federal Reserve backlog orders. And you look at the last 3 or 4 freight cycles where backlogs went up and then dry van rates went up. The start of this year, backlogs were going up and dry van rates were going up, and then Liberation Day happened and backlogs started to plummet.
Yep.
April, May, June, July, and then dry van rates went like that. There's no question this market was improving December, January, February, March. No question about it. We were all talking about it. And then, of course, everybody hit the pause button because everyone said, oh, crap, we need to start thinking about our worst case scenarios in our business plans that we always had on the back burner, because everyone has a best case, bull case, worst case in our business planning. And even my wife's catering business has a worst case scenario in their 2025 business plan. And everyone went, oh, crap, we need to think about what's the worst thing that could happen this year. And of course, that even wasn't good enough because nobody really knew.
It's even worse than that, right? And again, just for anyone listening, right? Like the one example, I was talking with a furniture company that basically sells furniture and stuff for your child's bedroom. So like the beds that are cartoons or Marvel or whatever, and dressers and things. And they're like, listen, we were buying our furniture in the 90s in the North Carolina area. Like they made it there and we were able to buy it there. But we haven't even been able to buy it in the United States for like 30 years. And Jason put out a post and he went, if you look at the employment in just that industry, right, it was like at 90,000, I think, in North Carolina in the 90s at its peak, and it's half that. So what happened are these companies that are selling products and have been selling them for 25 years that have no choice but to pay, in some cases, a 30% markup on the things they're buying to sell to us. And we're trying to act as if like that wouldn't have an effect on companies.
Right.
And then someone asked me the other day, they went, well, why is the stock market up? I'm like, well, the stock market is up because AI spending's up. If you take that out, I think there's an argument to be made that like we are in for what could be like.
Right. Well, let me give you an example. My wife's catering business relies a lot on large universities here in Boston. Think about the attack on university policies from the current administration over their diversity policies. Right. So one of their big universities here, there's 50 universities in Boston. One of their university customers have cut the number of vendors in catering from 50 to 2. They've cut their spend from 10 million on catering to 5 million in a year. Haven't even spent anywhere near that. Right. So now you're talking about food services, fresh produce, right? So these are truckloads of produce, right? Now multiply that by across 50 universities. Multiply that across all of the cities in the country where they are afraid to do catering of events just to stay off the radar of the current administration, right? So this is why you are seeing such a big drop off in truckload volume of just food services, right? And you multiply this across all the other industries and all the other, whether it be manufacturing. So there is so much less volume being moved of all types of commodities because people are doing the bare minimum, with the exception of one area, and it's got to do with AI, and it's got to do with data centers. If you've got a flatbed or a drop deck or an extendable without riggers and an RGN, you will be driving the wheels off that bad boy, and you'd be hauling data centers and power, anything that's wide and high and ugly to the middle of nowhere. Like, if I had to come out of retirement, that's what I'd be hauling. I'd be hauling those bad boys all over the country for the next decade. Like, nuclear power generation is going to be the next big thing for, like, it's phenomenal. Guys, if you look at our flatbed rates, they're about 10 to 12 cents a mile higher. Like, I've been writing about it for about 3 weeks. They're tracking 2017. Remember, 2017 was a really strong industrial economy. It's more than coincidence that flatbed rates are identical to 2017, but it's not the same economy. It's just it's coincidence the rates are about the same. But it's because of, when you look at the underlying rates, the spot market rates are because of the data center construction boom that's going on, and it looks like that'll be continued for some time. So
interesting.
Flatbedders have been having a pretty good year this year.
So historically, because I was looking up the rates earlier, and flatbed is, I want to say the national average is like about $2.40 a mile with fuel. Does that sound about right? And that's for 40 cents higher than dry van.
Yeah.
Historically, though, if you go back like 5-10 years ago, is flatbed usually that different compared to dry van?
It's a good question. I'd have to pull that up. Yeah,
when you look at open deck, the more specialized it gets, it totally makes sense for rates, right? Because I mean, that's just your basic supply and demand. The supply of specialized equipment is going to be very, very different versus a dry van or a standard 48-foot flatbed. But
yeah, I'm talking more open deck, not necessarily highly specialized.
Just like a flat 48-foot flatbed.
Yeah, drop deck. Maybe drop deck is about as specialized as I'm getting.
Okay.
But so they've had a great year. But as for the rest, we're kind of running about 3 to maybe 3.5% higher year over year on the dry van and reefer side. But flatbed's probably going to have a much better year on the spot rate side. Contract rates are running about probably 1% higher year over year. But I think the bigger tell is that contract rates entering routing guides are still flat to maybe negative on the dry van and reefer side. Carriers are still not getting a lot of joy at the moment.
So speaking of flatbed, did you, a little unrelated, did you see the Montgomery transport situation? So I'm curious, I heard about it, I read a little bit on it, I know it was pending a sale and it didn't go through. would your analysis on that be that the sale fell through based on their lack of profits, based on the current market and what's going on, or is there something else in there that
it's something else?
They're a huge. It was a huge company, right? We're talking like thousand trucks.
I think it was 1,000
600
employees.
drivers. Yeah, 600 drivers, 1,000 employees.
Yeah, I think Stephen's right. Something else, Nate, because P&S has been very astute at rolling up a lot of companies over the years. And there's something else going on there. Normally, P&S roll up some pretty good companies. That's a very good operation. There's something else going on there that would normally have said if P&S were involved, that should have been.
That's who was going to buy it, right?
Yeah.
Okay.
Yeah. So I don't know enough to tell you exactly why. I saw their name mentioned. So there's something else that needs to be explored there, and I don't know why.
Gotcha.
So one of the things I wanted to have you ever seen the channel Smarter Every Day on
No,
YouTube?
I haven't.
Brilliant guy. He worked at NASA. He does like a lot of science videos, whatever. He did a video right around the time tariffs like were the big talk, and he was trying to produce his own like grill cleaner that didn't have the metal wires that hurt people, and it was next to impossible to get done in the States because it was too costly. Or one of the issues he ran into is the technology for manufacturing, like the tool and die process, that just doesn't exist in the States anymore because we've moved so much of the stuff out of the country. And one of the other issues he had, I mean, the video is like almost an hour long, but it's fantastic to watch. They were talking to Chinese companies where they had the plans, they would send them to them, and then they would produce it for you and send it back. And they found on Amazon where they would take the plans and they would reproduce your product with slightly different material, so it's not the same thing, and then they would resell it. So they'd use the same process, they would change a little thing, and then they would sell it. And that was kind of part of the issue that was being addressed with tariffs and all that stuff. So kind of leading into the flatbed and the manufacturing thing, do we think if this tariff thing is a long-term thing with the administration, data centers being a big thing, are we going to see a return of manufacturing in the States, or is it going to be something south of the border that comes up where we start bringing that specialized tooling process and making?
Yeah, it's a great question. I think that I tend to agree with what Jason Miller says. Anything that's highly specialized, I don't think you see it come back here for many, many years. Just the cost of investment. If it involves labor, it doesn't come back here. If it involves some big investment, yeah, I think over time, Stephen, I think you'll definitely see some of it come back. We're already seeing some of that manufacturing come back. I think, but labor's the big part of it. So it's maybe where Mexico comes back in because it's got lower labor costs. But wherever you've got something that involves people, we're always going to struggle with other countries that have lower labor costs. Footwear's a big one. We're having a big war with the Italian company that makes the handmade pasta in Italy right now. So I think it depends on the commodity. But if we can demonstrate that we can produce lower cost goods here with a big investment in technology, I think our challenge is how do we do so spanning this administration into the next administration? Like, I think that's just not this current administration and the United States. That's a global phenomenon, because that's been, I've seen that in my lifetime where I'm from in Australia, where you have a 2-year window where you got a 4-year period of power, but you've got 2 years to make policy work, and then another 2 years to hold on to the next election period. And nobody really, gets anything done in 2 years, and then you kind of nothing ever gets achieved. So I think that's sort of the problem that we've got here, is that nobody seems to want to make the right decision for the country, as opposed to a decision that benefits them staying in power. I would love to see a decision that's made for the country that spans multiple administrations. That would be the best possible outcome. That might be what we're seeing here. A lot of people in the country voted for change, and we will be. I'll be pleasantly surprised if we can bring manufacturing back to what Benjamin was talking about. that sees manufacturing come back to the South, where furniture used to be the big thing. Like, that would be great. Heck, I was in Salinas for a week, and picking produce is backbreaking work. I don't see people doing that. Like, there are some jobs that are just hard work. I don't know. We need labor for other countries to do that sort of work.
All right. So
I'm in,
go ahead, Steven. Sorry.
So I was just saying, I'm in Cincinnati, Ohio. My in-laws are in Indianapolis. So like, one of the things that's like anecdotal to me but odd to see is like the expansion of Indianapolis over the last couple of years is insane and completely like backwards to the rest of the country.
Right.
But one of the things that I'd be curious, and I don't know if anyone has it here, but like, has any, like Jason Miller or anyone looked at like the margins on products and commodities to predict if that manufacturing would come back first? Like, because I know like clothing is one of those things where people have started, American made brands, and they are here because it's a higher margin. That e-commerce is like 40, 50, whatever percent margin. So there's enough meat on the bones to like cut that down to 15, 20 and still be profitable.
Right.
Yeah, I'd be curious if anyone has like mapped out those commodities to like predict. The other thing I was going to say, you were talking about AI and the market. There was a report that came out today that 80% of the S&P 500 was related to AI companies, the growth.
Right.
Yeah.
Stephen, it's been funny over the last week. The word bubble has popped up. Have you noticed that? Like, we were talking about the last month, it was all about the AI boom, and now the word bubble has popped up. So I can't wait to see what next week.
It reminds me of the .com era if you go back 25 years ago, right?
Yeah.
Well, Dean, I wanted to wrap up and with we're just entering Q4 here, and given what you've seen this year, currently, and years past, for brokers and carriers that are tuning in, what would you say to them as far as how to set their expectations for what Q4 and the rest of 2025 should look like? What would be your explanation or prediction on that?
I think, I'm actually really optimistic. I think there's going to be some extreme volatility on regional lanes, so particularly reefer. Right, so I think you'll have your normal volatility for dry van lanes, e-commerce lanes. So Allentown, Boston, any of those e-commerce replenishment lanes where Stephen is in the Midwest lanes, like Columbus, Chicago, all of those distribution markets, like Phoenix, anywhere where you've got big warehouse markets, they'll be all trying to run those e-commerce replenishment lanes. They'll be very, very busy because people have got warehouses that are incredibly packed, and those last minute replenishment moves. So they'll be busy. I think you'll see a lot of high volume early Thanksgiving moves, hams, turkeys, Christmas trees, as per usual, starting November 1. So Pacific Northwest, North Carolina, Minnesota, Joplin, fresh turkeys start moving early November. Christmas trees out of the Pacific Northwest. So I think all of those typical things will happen. I think you'll see some really good volumes and rates for anybody that's got a refrigerated trailer out of the Midwest, Joplin, out of Minnesota, and out of North Carolina, all the way through to Thanksgiving. So I think you're going to see some pretty good volumes and rates for those carriers, because at the bottom of this market where we're at equilibrium, any surge in demand is going to see some pretty good rate volatility for carriers and brokers. So I think we're going to see some pretty good seasonality through the end of this year. I think it's going to be a pretty good market for carriers and brokers.
Awesome. Well, I'm looking forward to it.
Yeah.
Cool. Well, Dean, we appreciate it. I don't know what happened to Ben with his technical difficulties, but he's no longer in the conversation with us.
What's going wrong?
I don't know. He was texting me on the side. I think he had some internet issues, and then who knows?
Throwing things around in the background.
Hurricane season in Florida, even though there's no hurricanes there right now, but. Anyway, Dean, we're happy to have you on.
Thanks, guys.
We love what you do. Every Thursday in our twice a week newsletter, all your rate data for the market, dry, flat, and reefer. We share that in there, and it's super helpful. So thanks for that. And if you guys aren't subscribed to the newsletter, please do so. Dean does a lot of work to take all the minutia out there and put it in a digestible form. So make sure to check that out. Anything else, Dean, you want to wrap up with?
It's truck show season, so there's a bunch of truck shows on here in New England. Lots of good causes. So if you don't follow me on social media at the Grumpy Pete, there's a lot of good causes that we've got going on to support. A lot of sick kids. There's Toys for Tots. Bunch of things. We're always raising monies, but I think Toys for Tots is the big thing we're doing this year, as always, raising awareness for all of the underprivileged kids that need help this Christmas.
Awesome. Yeah. I feel like Toys for Tots has to have been around for 100 years now.
Yeah.
And Steven, when you were a corpsman, right? And is that like, I know that's Navy, but you're attached to the Marines. That was like a thing every year that kind of like I don't want to call it forced volunteering, but that was always a big push for the Marine Corps side of things. So
so I was in the Navy for 5 years.
Yeah.
The only time I was on a boat was related to Toys for Tots.
Yeah.
For two weeks.
I gotta get my
time was the dirt.
I gotta get my Peterbilt cleaned up and waxed and polished the next couple of days for a truck show Saturday. So
nice.
I think we've got truck shows every Saturday now for the next 6 weeks. Kind of like this is kind of peak truck show season in fall up here in New England. It's a pretty big deal for raising awareness for Toys for Tots and all those sorts of events.
Awesome.
Yeah.
Well, cool.
All right.
Thanks again, Dean, for being on with us, and we'll definitely catch up with you. If not later this year, into the beginning of next year, and we'll see if any of our predictions or thoughts were remotely accurate. Right? Yeah. That's the one thing too that we try to look at what's going on, what's happened in the past, and predict what the future will look like, but there's the unknown things that can just pop out of nowhere that COVID, nobody saw that coming 6 months ahead of time. So
there'll be something. We had an eerily quiet hurricane season, so that
that's
blow the doors off.
Very strange. Very strange.
Yeah.
But
all right.
Thanks again, Dean. We'll see you again soon. Okay. Ben's not here to do his sign off, but thanks for listening, everybody. And until next time, go Bills.
Go Bills.